Welcome, everybody.
Well, good morning, everyone.
Glad you joined us this morning for our Daniel Krug and Associates Wealth Management Review for November 19th, 2020. Today's presentation is titled Short-Term Pain versus Long-Term Gain. My name is Rocky Istan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug will be joining me in just a few minutes to help out with the presentation. Dan is the CEO and Senior Wealth Manager at Daniel Krug and Associates. But before we get started, a reminder that this presentation is for informational and illustrative purposes only. We're looking at a little over 30 minutes for the presentation. We are recording this session for review later. It will be published later. Everyone will be muted on the call. However, you can use the chat room to ask any questions, and we'll be monitoring the chat room, or to just say hi to us and let us know you're out there. We want to thank CNR and the Capital Group for their contributions in today's data presentation. So just a reminder of what wealth management means to us. Your overall investment strategy is the foundation of what we do. Where we find our expertise is in the advanced planning strategies, things like wealth enhancement, and you can see the different subcategories there: wealth transfer strategies, wealth protection strategies, and charitable giving strategies. So many things that we do to enhance your wealth over your lifetime. We're going to get into the agenda here. Today we're going to be covering major developments this week, an update on COVID, talk a little bit about where the markets and the economy is at, giving you an overview of portfolio development process, how we work with our portfolio managers, and then concluding with opportunities and strategies update at the end. We will have time for Q&A, and we will check and monitor the chat room for those. At this point, we're going to stop the presentation just for a second, and we're going to hop on the camera here to say hi. Good morning, everybody. Wanted you to know we're broadcasting from the office. Some of you have seen it, some have not. So welcome. We're looking forward to you guys coming in. And Dan, any comments?
Absolutely. This is the first one we're actually doing from the office that's live on our webinar jam. And we're actually really excited about this. Yesterday, was it yesterday or the day before, when we had the Shred Day, we had multiple people come into the office. It was so great to see everybody. We've been kind of starving for seeing you guys. We just haven't been able to, we haven't been able to get our hugs in. So, we're looking forward for this whole crisis to be over, which hopefully, based on the information we're going to be presenting today, you'll see that there might be some light at the end of the tunnel. And it is the opening to the tunnel, so not a train or anything. So I think there's going to be some great stuff coming down the pipe here. So, Rock, you want to go ahead?
So major developments that have happened since the last time we updated you on our webinar. The vaccine breakthrough, big news is that we're seeing a lot of positive results from the big firms that are out there developing the vaccine, all with their little different strategies and approaches to it. But it seems like we're getting a high success rate, over 90% effective from most of the companies. So that's a good sign. And obviously the economy and the markets are kind of depending on that vaccine coming in to end the pandemic. The next few months of economic growth are likely to moderate, though, because of the increase we're seeing in the short term here. But we still believe in a very strong second half of 2021. So the outlook is still looking good for next year. We're going to go into a little bit more detail on that. Stocks have rallied recently due to the discussion, and the timeline for the vaccine is being really accelerated. So that's positive news for the market. The 2021 earnings are projected to be a good 10%, plus or minus a little bit there, higher than all-time earnings highs. So a lot of positive things that we're seeing for the economy going into next year and through next year. However, valuations of equities are currently high and are likely to remain so, but there is going to be strong earnings along with very, very low interest rates, which bodes well for stocks. The job market we see continuing improving. However, it is choppy as right now we're going through some slowdowns because of new restrictions being put in place. We're going to touch on that a little bit on the COVID update. We see a couple million jobs being generated next year, so that's an improvement. The stimulus talks, though, have been stalled. A lot of uncertainty around there, and we believe that it's actually needed with what's going on with this increase in the COVID cases going into the fall. And like I said, we'll touch on that a little bit more as we go on. Monetary and fiscal policy decisions remain dominant forces to the economic activity. The Fed is continuing to pump capital into the markets. What we need is the stimulus on the other end for the consumers to be able to participate in that and continue their spending. We're going to touch on that in a minute. COVID cases continue, as I've said, to rise. They're at high levels in the US and Europe. And also hospitalizations and fatalities are rising as well. So the next few months continue to look to be challenging from economy and global response to COVID moving forward. So what I'm going to do is turn this over to Dan, and Dan's going to take over and talk a little bit about COVID.
Yeah, so a lot of great information that you've got there, Rocky, on the developments coming on. So, you know, I'm seeing nothing but good news coming down the road if we can get past these next few months. So I'm going to start talking a little bit about the COVID. I'm not going to go too deep into it. I'm going to run through it relatively quick here. So let's go ahead and get started on that part. All right, we're going to get into the nuts and bolts of this thing, put it all together for you, and we are going to start with Michigan. Most of you are familiar with this heat map here for the state of Michigan, and Michigan is divided into 8 regions. Michigan has 6 stages to the Safe Start plan. And right now, as you can see, we're in pretty dark purple. And it's kind of unclear right now what's going to happen with opening in the future, especially with the spread accelerating right now. And we'll go into some real deep numbers here for you. When you're looking at Michigan statewide daily tests over time, the 7-day average, they're actually producing over 57,000 tests on that daily average. So that is huge right there. If you think about it, April, we were doing a little bit less than 4,000 on the daily average. So we have dramatically improved as far as the number of tests that are being done. Now, as you can imagine, more tests mean what? It typically means more people are going to have found that they do have COVID because they're actually being tested now. Now, that being said, if you look at the positive test rate, we're up to 13.8 right now. You go back to April 1st, we were at 34.8. So that was really kind of the height of what was going on with the initial spread. Now, if you compared those two numbers, you'd say, well, that's great. It's gone down. But if you go back a month, or a month and a half, you would have found that positivity rate would have been just about 10% less. So we are seeing a bit of a surge right now. You look at the cases per million over time, the 7-day average on that is about 57 people per million that are catching it on a daily basis. You go back to the outbreak, we were at 128, so kind of a little bit less than a half of where we were before. Now, this is probably the most important one here, and that is the statewide deaths over time. So when we're looking at this, we've got, as of November 1st, we've got about 47 deaths. That's the daily average. Again, going back to April, it was about 172. So considerably less, but certainly a lot more than it was just a month or a month and a half ago. So let's recap on Michigan. We've got testing, which is really, really robust at 57.4 thousand daily average. The positive test rate is higher than it was about a month ago by about 10% at 13.8. The average new cases is about 47 a day, basically. And then the average deaths are up to about 47 as well. So it is something that we're concerned about. Obviously, everybody is. And guess what? We're back in lockdown again. So it's all designed to try to curb this thing, keep people safe, healthy, and we'll keep monitoring it as we go along, because it does play into what's going on with our investment strategies. So let's jump over to Europe and US as a whole. So what do we have here? When you're looking at the US national cases, the hospitalizations and the fatalities, what you're finding is that the hospitalizations have really surpassed the previous peak. That said, it doesn't mean that the deaths have gone that same direction. Now, they have gone up, but not quite as high. And I've heard multiple clients, multiple people that I've talked to actually say that, wow, the US is in so much worse shape than Europe is. And I'm like, I don't think that's quite correct. So we actually did a little bit of research. As you know, the US population is about 332 million people. And our daily average fatality rate is at 0.00069. Now, I say that again, only to look at how are we doing compared to Europe. Now, Europe has 28 member states. They have a population of 447 million people, and their daily average fatality rate is 0.00081. So they're about a third higher in fatality rates than the United States is. So actually, the United States is doing a whole lot better than Europe is, even though you've got in Europe, some places have really locked down, others have not locked down much at all. So they've got a kind of like us, they've got a mixed bag of nuts on how they're handling it. So not too much dissimilarity there, but certainly in the US, we're having a much lower fatality rate than Europe is at this point. So that's the Europe and US. Now, when you're talking about the US, going back here again, the responses of the new restrictions since September 1st are really kind of weighing on people's hearts right now. Why is that? Well, when you look at it, there is a lot of states that have increased the restrictions on workplace, restaurants, and bars by almost 70%. I mean, that's pretty harsh. Social gathering sizes the restrictions have been increased by over 50%, and you can see the other gatherings as well. Now, we don't hear that there's going to be a nationwide lockdown, but certainly each state is targeting specific areas that they're working on relative to trying to control the virus spread. So it does play into what's going on for the US. It does play with what's going on with the economy. Now, when you're talking about good news, well, there is some really great news out there. The vaccines are expected to become widely available by spring. That's a big deal. When you look at this chart, what it's showing is that we've got multiple companies that are coming out with a vaccine and are expecting to put it into use by December. So if you look at the chart, the way this is broken down, you've got the different biotech companies, the pharmaceuticals that are creating the vaccine. In December, they're expecting to have between 5 and 10% of the population inoculated. So that is a huge deal for this vaccine. January, they expected to go to 10 to 15%, February, 20 to 30, and by March, okay, so the end of the first quarter, 40 to 50% of the population being vaccinated. That bodes very, very, very well for the economy and certainly for the safety of every individual in the United States and worldwide. So the great news is the vaccine's coming, and it's going to get here, and there's a lot of positivity relative to the testing on it. So this is all good news. I'm sure it's been all over the news and you've heard it already, but this kind of puts it into perspective as to how quickly this could get into play. So they're looking at, even before the end of the second quarter, having more than enough to take care of 100% of our population when it comes to the vaccine supply. That said, let's move on. Rocky's going to talk a bit about the markets and the economy. And so what do you think about the news on the vaccine and everything?
It's looking pretty good.
Yeah,
that was a big deal, the announcements this week alone, how things are rapidly coming along, the success rate and everything like that. So
yeah, it is neat. I mean, love Trump, hate Trump. He said it was going to come before the end of the year. You know, thankfully it is. You know, that's a blessing for everybody to get people vaccinated so they can ultimately go back to their lives and not worry about it. So Rocky's going to take over on the markets and the economy.
So let's go on. A little bit of a change of direction here, finishing up with COVID. Let's see what's going on in the economy. I'm going to start with a slide that talks about what's really changed. Big changes due to the pandemic, but it's really just an acceleration of a longer term trend. And what we're talking about is e-commerce. If you look going back to 1999, online shopping and things like that, e-commerce have really been growing year by year. But look what happened in 2020 with the right side of the chart and the straight vertical line practically due to COVID and being shut down, how much buying things online, managing your businesses and accounts through e-commerce has changed the landscape for sales in the United States. It's a huge jump. And if you notice the dotted line, that we are planning on seeing that trend continue from that high point, not actually dropping off. So that's pretty interesting. And believe me, the money managers are looking at this data and looking at how that plays into your portfolio structure. Consumer spending has slowed recently due to the local restrictions that are being put in place, but we believe it's going to be short term. As you can see on the right side of this chart, there is a little bit of a downward trend going on right now. We expect that to go through the end of the year. Hopefully the Christmas season can pick up that line a little bit, but we believe, again, this is only going to be in the shorter term, and we will be off and running next year. And you can see that actually in this, where we're showing more of from a consumer consumption standpoint, that the consumer spending will continue to be on an upward trajectory through the balance of next year. So that is good. One of the things that may be hindering this a little bit is the lack of stimulus right now. And that's something that we talked about up front might be needed to keep the economy moving as there's restrictions put in place. But with the continued progress with the vaccine, we expect activity as that vaccine becomes available to continue to pick up and grow. When we're looking at income and savings, what's going on here, basically, you can see where the CARES Act in the chart back in the beginning of April, going into the beginning of the summer, when the stimulus checks and enhanced unemployment checks went out, that even though the income was dropping, there was money in the system, and that's what was reflected in those previous charts. Again, we're saying more stimulus is needed. So the CARES Act ends at the end of this year, and there will be need for some kind of extension for enhanced unemployment benefits, slowing the eviction process and loan forbearance for people that are unable to make their mortgage payments and stuff like that. Those kinds of programs have to be continued Otherwise, we're going to continue to see a decline in income and savings. But we believe that that long term is going to be worked out, and we're going to see an improvement in 2021. This is interesting to see because one of the things we've talked about from a market standpoint is how that we're underweighting Europe. So this is a good way to kind of see the US on the left side of the graph, Europe in the middle, and China on the right. What's happened is with the second wave of COVID, they've been shutting down significantly. And so due to their widespread restrictions, you see that their recovery is actually waning. It's going in the wrong direction. The United States has been more resilient, and based off of that, we see more opportunity for the stock market in the US than in Europe. And also China, when you look at them on the right side, it's slow, but it's pretty steady, slow growth. We don't see any decline over there. And to continue that discussion farther, let's look at exactly how performance has taken place in the markets over the last 5 years. The United States has been up about 12%. Europe, on the other hand, only about 2%. Emerging markets, which this is just the Asian emerging markets, about 10%. But when you look at emerging markets as a whole, it's excluding Asia, everything outside of Asia is actually down. They're going in the wrong direction. So when we talk about portfolios and passive versus active allocations and strategies, this is why you need to be tactical during this time. You just don't want to hold an index. You want to know what the trends are. You want to be looking at where the growth opportunities are at and avoiding or minimizing your exposure to some of these markets that are not performing. Looking at the stock market, comparing this year to what we're expecting for next year, you can basically again see the United States on the left half. The black bars represent where we believe 2020 is going to end up. And the blue bars represent what we're forecasting for 2021 in corporate profits and earnings for next year. So going back to the left side of the chart here, the United States, we're expecting about an 8% drawdown in revenues and profits this year due to COVID. However, next year, the forecast is about a 16% growth in profits and revenues, which will bode well for the stock market. If you look at developed international, which is the European economy, down about 30% this year, we're looking at about a 20% growth. And you might say, wow, that 20%, that looks pretty good. However, when you go down 30% and you can only come back 20%, what is that actually saying? They're not even getting back to their end of 2019 levels for profits and earnings for the corporations in Europe. So that, even though it's a good sign that it's going to be positive, they're not expected to get back to even next year. Again, another reason it makes sense to be tactical and looking at what trends and where we need to be invested for the future. And as that changes, we can adjust the portfolios. Dan?
Yeah, Rocky, it's interesting when you look at the U.S. and the fact that they're projecting a -8. If everybody goes back to the beginning of this whole crisis, they were literally expecting double digits from a negative side for the U.S. alone. So it just shows you the power behind the U.S. economy prior to what hit with COVID. So I'm really, really pleased with the numbers that I'm seeing right now comparatively.
Yep. And when we add Asia into the mix, they are going to be about the same. They really didn't take the big hit. They had the most V recovery, the shortest recovery. The United States was not far behind that recovery, but they're projected to maintain basically the type of growth that they're going to experience this year. So again, you can see the United States from a growth standpoint has about the most to gain, and that's where we are focusing our portfolios right now moving forward. And speaking of portfolios, I want to give you an overview of what our process is working with our money managers. So, and we are going to go into more detail next month, I believe, Dan. This will just kind of give you an overview taste, and then we're going to dive deeper into what those actual strategies look like. But from a 30,000 foot level, here's kind of our framework for portfolio development to achieve your goals. It starts with a money manager, the portfolio managers, and them coming with, on the top there, their asset mix, a stock and bond strategy. What is their overall strategy that they're trying to employ to either grow income, grow your account, so on and so forth, or protect your account? So they come up with an overall strategy, and then they drop down to the next level, and that's your equity mix. What do we need in the portfolio to achieve that strategy? Large or small stocks, US or international, growth or value. Again, we just showed you why you want to be overweighted in the US and maybe China versus Europe. You know, when you're looking at these trends, they're constantly looking at what equity mix is going to meet their strategic goals for the portfolio. Then you get into the actual research and the fundamentals that they monitor on a daily basis and the trades that they actually make based off of the fundamentals. So this is where the research is done in the stock and bond selection that's going to give them the proper equity mix and meet the ultimate strategy objective of the portfolio. So that's where the portfolio managers are focused on. Setting a goal for the portfolio and working towards that from fundamental research standpoint. Our job at Daniel Krug and Associates is sitting with you and talking about your goals, your values. What do you want to accomplish financially for your future? And then we go to those managers and create a custom portfolio, pickings and selecting different managers using separate accounts for each of those strategies so we can monitor how those strategies are doing against our goals. And ultimately, the portfolio construction management, after we've created that custom portfolio for you, to rebalance it, to harvest losses and gains in the portfolio. And then timing is as things change with your goals, what do we need to change in our manager selection to meet those changing goals you have? So we're constantly working with the managers that they're achieving their goals and that you're achieving your goals. So that's our job, is being that go-between for you, plus all the advanced planning strategies. This is just focusing on building a portfolio to meet your goals. Again, we're going to go into more details on this in the next month's webinar, going into more detail on specific strategy types and how they work. So we might come back and touch on this, but then dig a little deeper. We want you to also start thinking a little differently with what's going on because of the low interest rate environment, you know, and the volatility that we're seeing. So instead of thinking in terms of stocks and bonds, we want you to think in terms of, where are my sources of returns going to come from? And when you look at this breakdown, starting at the top, dedicated growth strategies, what you're going to see driving portfolios is going to be U.S. equities, large, small, mid-cap companies, internationals, whether developed and emerging, and constantly rebalancing that portfolio based off of the trends that we're seeing in the economies. Then growth and income strategies. Since we're in such a low interest rate environment, you're going to see more high dividend and income equities, plus opportunistic income. And I'm not going to go into detail on that today. That'll be the next, but that's an area where you're more actively managing and looking for shorter term opportunities to juice that income portfolio a little bit, but that has to be tactically managed to do that. If your goal is safety of principal, you know, your core fixed income portfolios have done an outstanding job of capital preservation, you know, and providing some growth to maintain your inflationary value of your portfolio so you don't lose money to inflation over time. And finally, alternative investments. And this could be alternatives towards income, like we talked about, opportunistic, or other types of alternative investments. for growth or total return portfolios, we have equity alternative strategies, and then fully diversifying your portfolio with additional things such as commodities, private placement, real estate. There's a whole bunch of alternative investments outside the stock and bond markets that we incorporate into portfolios to either enhance the income, enhance the growth, or further diversify the portfolios. So again, we're going to go into a little bit more detail on that in the next meeting. Our money managers are focused on high quality companies with reasonable valuations, and they have a reason for this. So I know there's been, in this time, there's probably, Dan, been more speculation over the last 12 months with some of these technology startup companies. And everybody's like, how do I jump into that? And how do I jump into that? Well, the thing you don't hear is for every one that's a winner, there's probably 9 losers. So if you really don't know how to play this market, it is highly, highly speculative. Plus, look at the profitability. So when you strictly look at profitability of an emerging technology stock versus evolving consumer, the digital revolution, or healthcare innovation, speculative companies' profitability is a minus almost 40%. So you're literally buying stock that is losing money.
Now, some might say, yeah, but what about all the ones that are winning? Because I always hear someone saying, hey, they bought into this and they just won big. But I guess that goes to the number of stocks that go down to the ratio on the ones that go up. So I guess they just got lucky on that.
Yeah, and our money managers have proven over time that it's not stock selection. It's really understanding the trends and being in the sectors, because you don't know who's going to be the winners and losers. Let's also look at valuations, though. When you're looking at what you're paying for that stock compared to other technology stocks, you're probably paying 4 times over in the price of the stock versus other types of technology. So we're not against the new trends, but you don't want to build your portfolio around speculation. You want to build it off of fundamentals. And if you're looking for a certain rate of return, we can achieve those without getting highly speculative. So that's the point of this chart, is to know that the money managers will focus on that. They're not just trying to take a chance with your money. They're doing prudent investing. They might have some of these positions, but it'll be very, very small in the overall scheme of portfolio development. So I hope this was helpful, especially with the volatility going on. You're going to see a lot of things changing over the next year, but we believe the fundamentals for 2021 are going to win out.
Yeah, it's going to be an interesting year moving forward, because there's so many positive things happening out there right now. And speaking of that, let's kind of look next at the opportunities and strategies. So what we want to do is give you a bit of an update where we are on each one of the strategies for clients, so you can better understand what the next moves are. So let's take a look at it from there. Let's see. So opportunities. One of the things people keep asking is, should we be concerned about the sell-off in the market? And at the end of the day, the answer is not if you have a plan. And we have a short-term, long-term, and contingency plan. And we'll talk a little bit more about that. So our strategy actually takes what is given to us, puts it together into something that's actually going to function for you. So looking back at the strategy playbook, the first part of the strategy really is the active management reallocation sectors. You know, Rocky already talked about that. We've got money managers right now that are constantly looking at the different sectors. Think of it this way. When we started into this market crash in the beginning of this year, we had stocks like Delta in there. Delta was that travel industry or part of the travel industry that is just got decimated right now. If you looked at your portfolios, you would have seen that they started pulling out of stocks like that on the way down, because they knew that it was going to hit them hardest. So they were reallocating out of those sectors, and you saw them going more heavily into the sectors that work on technology. You know, yeah, healthcare too. So you saw them reallocating. That's happening on a daily basis with the money managers. So let's go on to strategy 2. Strategy 2 is the Roth conversions. The Roth conversions, some clients have taken Roth conversions and instituted it already this year. Some have not. What I will tell you, we were waiting for a dip before we got that Roth conversion in for most clients. The dip never happened. We believe it's still going to come, especially the longer these closings are, the more damage we're going to be feeling with a lot of the companies out there. We could still see that dip in the market in 2021, but we're running out of time this year. So we want to make sure that all Roth conversions that need to be implemented are implemented before December 15th of this year. Why do we pick that date? Because the institutional money managers, everybody who is working in operations to get this done, if they come in after that 15th date, there's a very high likelihood it's just not going to get completed, because there's going to be a rush to get this stuff completed before the end of the year, not just with our companies, but other companies out there. So we want to make sure the Roth conversions are done before the end of the year. Now, if you believe that Biden is getting in based on the tax laws that he is proposing, there is a question if the Senate is held by the Republicans, whether any of those new tax deals will go into play. We're not sure, but some clients are doubling down this year on their Roth conversion, saying, hey, I'm just going to hedge. I want to make sure that I get as much converted over before we do start seeing taxes go up. And again, I haven't talked to too many people who think it's going to do anything but go up in the future. And that includes everybody. It's not just the rich that are going to get hit here. Never has been in tax history. It always starts with the rich and then trickles down to us common folk. So we want to continue on with the Roth conversions. So that's strategy 2. Strategy 3, the draw and let heal strategy. This one has worked out very well for clients. We are now reversing the draw and let heal strategy. What do I mean by that? Well, back in the beginning of the year, we stopped taking money out of the market because we didn't want to accelerate the losses. We started taking money out of home equity lines of credit and, or more popularly, the overfunded life insurance. So now we're going to reverse that process. Clients are going to have their income starting back up in the stock market, and we're going to repay the home equity line of credit and the life insurance. So at this point, most of that has been completed. There are still a few more that we're working on, but that will be done soon here. The other thing I would say, once we get everything back into place where it was before from a investment standpoint, if we have another dip in 2021 or further out, we will implement that strategy again. So that's always there and ready for any kind of downturns in the market. Strategy 4, the risk up strategy. Again, the market came down and it went back up so fast, we couldn't really implement that one, but we do have the plan ready for every client. So again, if we have that dip down in the market, that W that many of us are expecting, we will do that risk up at that point. And then strategy 5, we did have clients that had money on the sideline. We're really waiting for getting it into the market. Many of them had gotten it into the market, really exercising that old adage, buy low, sell high type thing. So ultimately, that's the strategy playbook and the update on the things that we're doing with our clients. So you may say, tell me more. Well, we're running out of time now. So what I would really recommend is going to our YouTube page, the Daniel Krug and Associates YouTube channel. And there you can see all of the webinars that we've done. We've taken each webinar and we've broken it down into 1 to 5 segments, shortening the time. So if you don't have the time to watch the whole thing, you can really target what you want to see. And just a reminder, the last webinar we had was on October 8th. In that webinar, we talked about election tax planning. So you can actually, again, go to our YouTube channel and you can take a look at the Trump plan compared to the Biden plan, so you can see exactly how the taxes are set up in each one of those plans. This information is coming from institutional money managers, not just from us. So it's good, solid information so you understand how the taxes actually work. So that being said, we're going to question and answer. So I'm going to turn it over to Rocky now. There we go. We're back. And so question and answers, do we have any, or did we do such a great job that we baffled everybody? They have nothing to say at this point.
I think that the information was so good that they are like still digesting it. The big thing is we are going to continue kind of on this theme of portfolio construction, especially since we believe next year's looking really, really good, how we want to get things positioned for next year. So, and that's probably our next set of meetings with clients, is really going through how are they sitting today and what do we see for next year, and do we have to make any adjustments?
Yes.
Which is pretty common practice as we have our meetings with our clients.
Yes.
So anyways, there's no questions out there right now. We seem to be at the 45-minute mark. It was great to see everybody on the webinar today. We just remind you, there's no need for you to worry. You take care of your family and we will take care of you. So we're going to be changing this to we're ready for 2021 and beyond.
Yeah, we're getting close.
So good to see everybody. Thanks again for joining us, and everybody have a great day.